Hello and welcome everyone to my financial literacy podcast where we take complex financial topics and break them down into bite-sized pieces. My name is Carl Weiss and I'm a residential loan officer at Fairway Independent Mortgage Corporation. My NMLS number is 263293. I'm licensed in over 21 states, and what we'll be discussing here today specifically applies to our friends, family, and clients who live in Arizona and Texas, although I feel the topics covered today will apply throughout the U.S. It's our desire to help educate and provide serious value to assist our clients and friends to understand money, manage money, make money, and grow, or at least keep more of their money while mitigating risks. Today, we're joined by Rachel Rojas of Goosehead Insurance. Rachel focuses on property casualty side of the insurance world, and she's going to be discussing in depth homeowners insurance and vehicle insurance in our podcasts. Welcome, Rachel. How are you today?
I am doing great. Thank you so much for having me, Carl.
Absolutely. Super excited. A lot of us have, some form of insurance, and it gets complex quickly. And I don't think a lot of people really understand the inner workings, so that they even know how to make the right choices or even what some of those choices are. So I'm really excited about today's podcast so that we can dive deep and understand, as we kind of sequentially go through the types of insurance, starting with the homeowners insurance and then moving our way down to vehicle insurance, so that people kind of have a frame of reference of what does it mean and why do I have it? Should I have it? Is it necessary? Those kinds of things. So thank you so much for helping us understand that. And in case I'm wrong, would you mind telling people exactly where you're licensed?
Yes, so I am an independent insurance broker. I am licensed in the state of Arizona, which is where I'm from, and then in the state of Texas, which is where I reside in now. I love being a part of the insurance community. It's no one's favorite topic, but it is a very important topic. So if someone can leave with something that they've learned today, that's all I'm hoping for.
Yeah, I love it. So let's jump right in, and I love it that the two states that you happen to be in and from are also states that I'm licensed in, so that works out really well. And again, I think a lot of this stuff applies nationwide, but specifically because of both of our licenses, we're going to kind of keep it more centric. And if anybody has any, you know, individual questions, I would say please reach out to Rachel directly. Even if she's not licensed in your state, I'm sure she can pass you along to someone who is. And the same goes for me. If you have a specific mortgage question and you want to get uh, a little more depth on an individual topic, please reach out directly. So let's start with the homeowners insurance, kind of the basics, and I really want to try to do a good job of not throwing a lot of mortgage lingo and jargon into these podcasts because I think it muddies the water a little bit for somebody who's really just trying to get a fundamental understanding. So if I'm using really basic language for those of you watching who are very complex in nature, bear with us. Yeah, we're trying to build on a foundation here. So um, tell us a little bit on the homeowner side, what's actually kind of covered? What is the homeowner's insurance policy doing?
That is a really great question. I mean, it really stems down to the basics, but a lot of times the basics people don't even know. So, the first major thing here to know is that you have coverage for your dwelling, right? But what does that mean? That means that you have coverage for the structure itself. So this means that your dwelling coverage, which is decided based on a number of factors, that build up that replacement cost, right? This is going to be the maximum amount that your homeowner's insurance policy will actually pay towards a covered loss. It'll be based on that replacement cost, like I was saying, that takes into account so many different things. But the biggest things are just the characteristics of the home, the square footage, the number of bathrooms, any renovations, anything like that are going to be the biggest factors there. And it's good to know that once you have this coverage decided on, the remaining coverages are usually based on that. So for one of these, it's going to cover your other structures, right? This is a standard percentage of that dwelling amount. It'll cover any additional structures separate from the home. So think, a fence, shed, mailbox, all those fun things that would be covered under your other structures, right?
Okay.
Another thing is going to be, and a big one is your personal property. This one is going to cover, all the items in your home, your TVs, your furniture, your clothes, all that fun stuff. And then another thing kind of stemming from that is going to be your loss of use coverage. This is going to cover you if, the home becomes uninhabitable for a period of time, you need to stay elsewhere, like a hotel or something like that, you would be covered there. These are, essentially the standard property coverages. So it's going to be your coverage, A, B, C, D. And then your next major coverages are going to be focused around liability. So, when it comes to personal liability, this is if someone comes over your property and gets injured and on the off chance decides to sue you,
Hmm.
this would be, something that you're covered for. And then also related to that is going to be your medical payments. So it's if someone is, injured on the property and needs to go to the hospital, you can pay for their medical bills. These are going to be the core coverages on a home policy. And of course, there's so many optional coverages, additional coverages that are available, but that's just going to be the basics. And it's good that, to understand the basics before you decide to add on other things or extend coverages in certain areas, essentially.
So how would you like advise people? Because like when we start talking about replacement cost and what the home is, let's say prior to a loss, especially if it's a major loss,
Right.
um, and as it relates kind of to the personal property that goes along with that, I mean, should people be, kind of walking through once a year, just taking pictures of every room in the house just so that they have an actual, you know, visual representation if they had a claim that they needed to provide information to an insurance company to say, no, this is really the stuff I had.
Yeah, that's a great question. I mean, every year, if you see your rate go up, and some of that is because the replacement cost was increased, that means that the insurance company is taking a look at, the cost of labor, cost of materials, construction costs, all that kind of stuff, and are saying, okay, we actually need more coverage on the home because of these reasons. But obviously, there are some things that just automatically the insurance company wouldn't know, and it would be up to you to tell them. For example, you have major renovations in the home. This doesn't mean like, oh, replacing your tile. This would be, oh, we're adding another bathroom, we're adding another floor, we're, replacing the roof. Those major renovations can, really increase that replacement cost.
Okay.
And it's a matter of you actually reaching out to the insurance company and letting them know that way, all factors are considered and that your coverage doesn't, diminish over time as a result of inflation and all that stuff.
Okay. And how does that work on the personal property? Is it sort of, your word against the insurance company as far as like all of my pots and pans are amazing. They're not just cheap Walmart stuff, right? How do you sort of go down that road of what you have or an inventory, if you will, of what's in the house?
Yeah, that is a great question. So typically you will see standard percentages of your personal property on your policy. So for example, say your home is worth $500,000. Standardly, you'd want about 50% of that coverage dedicated, not of the dwelling coverage, but you'd want 50% of that amount in for personal property. So say you have a $500,000, house, you'd want $250,000 coverage for personal property. And this is just a standard percentage, right? If
Okay.
you think you have more personal property than that, you can always up the coverage, right? But
Okay.
insurance is only going to pay out as much as they think, it is essentially worth. They're not going to, you can't just add all this coverage and expect all of it to get paid for. And that's really where, especially with personal property, where those personal property riders come in. Because if you have something specific that is going to be more than the limits on your personal property, say you have a big one is going to be an engagement ring. If you have an engagement ring that's like, 5, 10, $20,000, you definitely want to schedule that separately. That way,
Okay.
if anything happens to it, it wouldn't just fall under the jewelry sublimit. So, say you have personal property and then there's sublimits for that. So there's, oh, $1,000 for jewelry, $1,000 for furs, all this stuff. And if you don't think that's enough coverage, by all means, have that as a separate rider on there. It's really just about determining how much, value your items have. But that's also not to say you can just, lie and say, oh, I have this much of stuff, because, you won't get covered for all of it. You just have to be, realistic with it. And you'll see when the claim times come, you know.
Right. Yeah, and so one thought that I was thinking about there was so the rider is just an add-on optional item that you can add to a policy. Can you sort of take those on and off over time? If you have a bunch of fur coats and you want to add a rider, and then 5 years later you don't have any more fur coats and you just want to get rid of it, is those are totally optional, I assume.
Yes, of course. Yeah. So riders are completely, additional. They're
Okay.
just add-ons, like you were saying, also known as endorsements and things like that. It's based on your personal preference and, risk assessment, all that kinds of stuff. And the good thing is you can always adjust those coverages. You can take them off, you can add them on, whatever you like. All you have to do is contact your agent and go from there. So
Okay.
you're not really stuck into anything at any point in time, which is good because, situations change. So you have the autonomy to change your coverage.
And how do you go about, like you mentioned the engagement ring. Do
Mhm.
you need to get stuff like that appraised? I mean, or do you go off the original cost? How does it work when you want to add that rider and say, I really want this, 5, 10, $20,000 ring protected. How do you prove what that's worth?
Yeah, that's a great question. So, you can't just give an estimated amount, really. You can just to get an idea of how much it would cost to put
Sure.
on there, but of course, the appraisal has to back it up.
Okay.
So, it depends on the company whether or not you would need an appraisal to even get the policy enforced. But sometimes, or if you write a separate jewelry policy, even which some people like to do, you may not even need to have the appraisal to get the policy, but you will need it to have that information in case of a claim.
Gotcha. So smart idea, probably if you have something high value, to check and see if it's worth, these are always the pros and cons, right? Whatever the
Hmm.
cost is of the rider, what's the likelihood of the you know of the loss, or whatever the case may be, to make sure that it's worth the cost. Some of these riders, I assume, have a different scale and they cost different amounts of money, so some things are probably worth more um, to individuals than other things, and so you may not get every rider, but you may have to pick and choose and decide which ones do you think are the most likely to have a challenge.
Of course. Yeah. And it's really up to, the individual person, right? Because on a standard policy, they're assuming that someone has standard amounts of, jewelry or maybe, a firearm or something like that. But it's in those very unique situations if you have very higher value items that you want to protect. So not everyone has them, which is why they're not, necessarily included at high limits. So that's where, you come in and you say, okay, I want to make sure we have this covered. That way, um, if you do have to submit a claim, you're not having to deal with that very low limit and thinking, oh, I'm not even covered.
Right. Okay. And so it sounds like, there's a lot of different riders available. What are some of the common ones? I know you mentioned, the furs and the rings, the jewelry. What are some
Yeah,
other things
so
you see a lot of?
so personal property is probably the biggest rider that I see because, people have those valuable items that they want to specifically schedule on the property. I would say the biggest ones that I see are going to be jewelry, expensive furs, firearms, fine artwork, kind of those unique, just, high value items, typically over $5,000 or so.
Okay.
Um, if you have, a nice piece of jewelry or something like that, but it's under maybe, $1,000, then you may not have to schedule that. You would
Gotcha.
just have to look at the sublimits on your policy, which are usually categorized by personal property item, and see if, the valuation makes sense. And if it's, higher value, then that's when you would consider the rider. Um, there are some other types of riders that are available, not related to personal property, even though that is, the biggest one. Um, for example, one of them is going to be for, water, certain types of water coverage. So,
Okay.
for example, water backup coverage, that's an endorsement on a policy that is completely optional. But my opinion, it's super important because if you have water backing up out of one of the main lines in your house, water or sewage even, the city's not going to cover that. So that's something that, if you see fit and you want that covered by your policy, you can add that on as a rider. Or say, your building maybe isn't up to code or something like that, or, at the time of a claim, and you want coverage to help pay for, the additional costs to comply with the local building codes after a claim, you can add build code coverage. So there's so many different ones available, but those are going to be probably the most important ones just because you see those situations more often.
Yeah, that raises an interesting question. So if you got a 30-year-old home and you have a homeowner's insurance claim, and they have to come rebuild part or all of the house, obviously they're going to go to the current codes, not the 30-year-old codes where when it was built, right? So there could be some additional costs and materials even necessary in those homes to even rebuild it, I assume.
Yeah. And that's a big one too with older homes, or historical homes. And that actually does play a part in the replacement cost, right? Because if you have a home that was built with certain materials that you can't find today or are harder to find, the valuation of your home might be a little bit different. For example, in much older homes, your home value instead of replacement cost might be functional replacement cost. So what that means is they take similar, materials and things like that, but not the exact ones from, 100 years ago because they may not exist anymore.
Gotcha. Okay. That makes total sense. And I know that there's a lot of communities that have, sprinkler systems on new construction that are required. And if you happen to have a home that was, predates that, you may have to have additional stuff. So I assume that in those zip codes, in those communities that have those types of newer codes, those are being added and calculated into the replacement cost, when you even initiate a quote for the insurance. Is that a fair assessment?
Yes. Yeah, because it's definitely not their first rodeo. People have homes of all ages. So they do, insurance companies do their due diligence to make sure that you're getting the right valuation for your home.
Gotcha. And that's an important thing. So tell me what's kind of not covered under a standard homeowner's insurance policy.
Yeah, so that's a great question. I would say there are a certain number of things that aren't covered that you would probably not even think about just right off the bat. For example, acts of war, something like that. You may not even think that that would even ever happen, but that actually is something that is not covered. So, nuclear war, as funny as that sounds, that is not something that is covered. But if you are dealing with that, you probably have bigger things to worry about
Sure.
than
Yep.
your insurance. Another big thing that is not covered is going to be anything, government action related. So something, the cops have to bust down your door to come and grab you. That's not, that your door isn't covered, but again, you would have bigger things to worry about. And it's good to know that some of these sound kind of, out there, but it's just good to know because if some of these things did happen, you would be caught off guard probably,
Right. Right.
Another big thing is going to be any intentional acts. So, for example, you can't burn your house down and
Of
get that money from it,
course.
right? Because that's just not fair to anyone. And then you probably have bigger problems then, as well. Um, and
For sure.
also general wear and tear is not covered. I think that's something that people get confused at with insurance versus a warranty.
Hmm.
So, if you don't upkeep your home, you don't do repairs, things like that, and you file a claim and it happened because you didn't upkeep your home, that's not covered. It has to be due, a claim has to be due to an event, not just to you not doing maintenance in your home. So, it has to be because of a tornado or a fire or something like that. Of
Mhm.
course, not one that you caused, but
Not deferred maintenance because you chose not to upkeep your property.
exactly. Say, you don't replace your roof And it's been, however many, it's just really, really old. And, it's just that general wear and tear. It's up to you to do that, get those repairs done on time. But that's, again, that's the side of a warranty, not insurance.
And I hear a lot of clients that have concerns and questions as it relates to the intricacies between a home warranty and homeowners insurance. And, I'm curious what your take is. I'll give you my 2 cents later, but when we start talking about claims in general, um, I guess I always think of like when should and should you not file a claim?
Yeah, that is a great question. I think the biggest thing to think about there is the severity and for sure the history of claims, right?
Mhm.
Because if you're dealing with a claim that is, absolutely catastrophic, this is why you have homeowners insurance, right?
Right.
So if something like this were to happen, you'd want to decide, okay, is it worth it to file the claim, right? If there is major damage to your home from a storm, from a fire, from theft, right? This is the exact reason that you have insurance and you'd want to file a claim. Of course, if you have, a small repair for the home that is close to or even below your deductible amount, it's not worth it. And another thing here is that if you do submit frequent and small claims, this is, huge red flag for insurance companies, which can lead to, for one, premium increases, which no one likes, but also non-renewal. And if you get non-renewed, then that's a huge red flag to other insurance companies. So it's just
Right.
a good idea to think about the, you know, severity of it, in order to think about when it's a good time to file a claim. And it's not to say you should file a claim, oh, something's wrong, let's file a claim. It has to be um, a thoughtful process for sure.
Yeah, you bring up something interesting, and I think people oftentimes underestimate the power of, lenders and also insurance companies. And, what one insurance company knows, you can kind of assume they all know.
Mhm.
Because they all have access to a database that tells them things about people's claim
Right.
history. And, just like we do in the mortgage world, like every once in a while we'll run a report and we'll find out that someone accidentally didn't report, some land that they own in another state because we have a recorded deed in their name. And they were kind of surprised, like, how did you know that? And it's like, well, we have software that does these kinds of things, and the insurance companies are no different. Um, if you filed a bunch of little claims and you have a challenge with one company, trying to get insurance in another company, you're not avoiding the issue.
Oh, exactly. I mean, you can't really hide when it comes to, insurance. Your history will follow you, but that's with anything else, like the internet, just everything, it follows you.
Right.
So even though some companies might be more lenient with claims, it doesn't mean that they can't see all of your claims.
Right. While we're on the topic, talk to us about claims. So if someone does have, they know what their deductible is, right? That's the amount that no matter what the claim amount is, that's their portion out of pocket. We see a lot of, either based on a flat dollar amount or a percentage of the home. So whether that's $1,000, $1,500, $2,000, or 1% of the policy. So that's the homeowner's responsibility. Um, talk us through a little bit of, how that translates. Obviously, we're not going to file a claim that's, less than our deductible. That would be really kind of crazy. Although I've seen people do it, it doesn't make any sense to me. But if you do file a significant claim, how long does that sort of stay on your record? And what are the impacts to premium once you filed a significant claim?
Yeah, that is a good question that I get a lot. Um, like I was saying earlier, it depends on the insurance company, right? And it's also the type of claim. I would say the standard kind of benchmark is anywhere from 3 to 5 years is how long it stays on your record. And because there's a range there, that really depends on the company. So some companies might look at your loss history from 5 years back and take that into account, or maybe 3 years. It really depends. And of course, it also depends on the severity of the claim, right? So if you have say you have a hail claim versus your home burning down to the ground, that's very different.
Right.
Um,
Sure.
and also, whether it's your first claim has a different impact on your premium than if it was, many claim, like your 10th claim. And also if you have a history of claims or all of that kind of matters. But either way you slice it, if you have a claim on your property, it will get taken into account. And of course, by a different range for each company, but it will most likely cause a increase in premium, which is, it's no fun because of course you get insurance to cover you and then you have to end up paying more later down the line. But it's just
Right.
because you have more risk associated, you know.
No, that makes total sense, of course. And we inherently know that, which is why I think people, at least in the homeowner side of the world, probably try not to create claims that are, more on the frivolous or low dollar value side,
Mhm.
compared to probably other ones that you see in the insurance world. When someone's shopping and trying to figure out, hey, where do I go for insurance? What's a reputable company? Who's a good professional to speak to? It seems that the insurance industry has kind of a couple of different categories of licensed professionals. Can you kind of break down that a little bit so that, where we have insurance agents and the brokerage side of the world?
Right. Yeah. So I think a lot of people get confused an agent versus a broker, right? Which, fair enough. They're both, licensed insurance agents. I think the biggest thing to know about that is that if you are going directly through an agent, they will represent their company specifically, and they will only have that company's product, right? If you go through a broker, you are allowing that broker to shop all of the different companies for you, essentially. And then that broker is your agent, but that broker is the point of contact for your insurance company. So, for example, you have one policy through one company, a homeowner's policy through one company, an auto policy through another. Your broker acts as your agent, just your umbrella agent over everything, even though you might have separate companies. So it really depends on kind of your preference, whether you want to go through a specific company or you want to see your options out there. Because I know a lot of people have people from certain companies that they work with for years and years, or maybe if you're newer to the insurance scene and you've never bought a house before and you want to look at your options and start from there, you go through a broker maybe. Um, I would say, the big difference there is just the amount of options that you have one way or the other,
Mhm.
because you can take your time to go through all the different companies and get quotes, or you could have a broker do that for you.
Right, right. Have somebody do kind of take the heavy lifting off your shoulders instead of trying to go reinvent the wheel, four,
Mhm.
five, six times, which we see all the time. And, we see a plethora of different insurance companies that come through and a lot of them, nobody's ever heard of before. And
Right.
you kind of wonder, okay, well, how did you get here? And I recently had one in another state that I'm licensed in where the amount was just so egregiously high it seemed on paper that we had to really do some more investigation and find out, okay, well, what's going on here? Was there a claim? Was there a challenge with the house? Why does it seem twice as much as a normal home in the area would be?
Mhm.
So we had to do some more investigation, and I thought that was interesting because there was, in fact, a claim on the home, and so the things start making more and more sense once you get a little more um, information and get down the road a little. So, and in the lending world, it's not so different either. I mean, we have mortgage brokers who can typically have the option of shopping many different companies for lending solutions. And it used to be in the banking world where it was more the proprietary, we have one product on the shelf and we go there. We're seeing a lot of bleed over in the last decade in lending where the brokerage side of the world and the captive sort of side of the banking world have melded. Where a lot of banking institutions now have access to directly to outside banks. So it's curious to see some of the mutations of the industries as they go
Yeah.
through time. So one of the biggest things that I see is roof problems, right? I mean, that just seems certainly in Arizona, and in a lot of states, they get a lot of sun and a lot of weather.
Right.
Um, how much does the roof matter for the insurance policy?
Yeah, so it's actually something that people may not completely be aware of, but the roof is actually one of the biggest factors when it comes to, writing an insurance policy. And the funny thing here is that most roofs, are meant to last. They're supposed to last, 20 years or longer, who knows? But from an insurance standpoint, they want the roof to be as new as possible, or else you might see some companies that might not be able to insure you or don't want to insure you. So essentially, the newer the roof is always going to mean a better situation from, an insurance standpoint, and more often than not, a better rate as well.
Okay.
I would say the kind of threshold that I see is about 10 years, right? So if your roof is over 10 years old, this limits the amount of insurance companies that will insure you by a good amount. And if you go to 20 years, that amount, gets increasingly smaller.
Mhm.
And then anything over that, you like, honestly, it's much more difficult to find coverage. I'm not even sure really why that is at certain times, because I'm even thinking, oh, the roof is, 10 years old. It's built to last another 10 years. But, I guess from insurance company standpoint, they just don't want to insure it because, roofs are a big claim.
Makes sense. And that I assume you're talking those time frames are more for like a shingled roof, or
Yes.
a flat roof compared to a tile roof, right?
Hmm. Yeah, and the material also does matter, because obviously some materials are built to last longer than others, so the
Mhm.
material matters. The age is the biggest factor, but material does play a play in it. And it is good to know that if you do have a much older roof, it's not to say insurance coverage is impossible, but the valuation of that might get reduced to what's called actual cash value coverage. So, typically you would have replacement cost coverage, but the actual cash value coverage would deduct for depreciation, which would mean a lot less paid out if you did have a roof claim. So that's just something good to know as well.
Yeah, that sounds like that could be a major limiting factor. Um, so you're saying, if I understand it right, if it costs $20,000 to get a new roof, but your roof before the claim was worth 5 grand, that the insurance company would say, okay, well, it's worth 5 grand, so that's all we're going to give you if you have a loss on
Right.
your roof.
Yes, and that's where it gets tricky because you don't want that to happen to you
Right.
at all. You definitely want, the depreciation is something you can't, that's just gonna always be there, that depreciation, if you don't have replacement cost coverage, unfortunately.
Makes sense. And you're still subject to the deductible there too. So if
Right.
you had actual cash value and the deductible out-of-pocket expense, you could almost find yourself in a position where it doesn't make sense to file that claim on
Oh,
the.
100%. Yeah.
Yeah.
And that's why it's always recommended to, replace your roof. Um, Not even on, I mean, from an insurance standpoint, to replace it, not when you think it has like its long life. So not, after 20, 30 years, but really, you should be replacing it every 10 years, which obviously is easier said than done because it's an expensive thing to do.
Right.
But that's just to say, if you replace it every 10 years, then at least you know that you'll be um, well covered for it.
Right. In the case of a
Mhm.
major calamity, right?
Right.
Well, let's take a quick break here. We are going to be back with more homeowners insurance questions and conversations. So everybody stick with us, and We will see you in the next segment.